Bell rolls is the reporter thrown into the secretive world of the Forex Super Model, where nothing is as it seems. Beware the techno monk, and steer clear of Professor Code and his two assistants. Give the senior trader a wide berth, and don't expect any sense from the risk manager. Hello, I'm Professor Code and this is the Forex Super Model video on how to place data bounce buy sell orders in Forex. Now if you're new to the channel, I'll explain what's going on quickly. And if you're we've been off the air for quite some time, and if you're an old lag, then welcome back anyway. So the first thing you need to do is understand that in the Forex Super Model we break up Forex into 8 complexes for trading, and they're the main. So you've got the majors: the dollar, the euro, the yen, the pound, and then you've got the CAD, Canadian dollar, Australian dollar, New Zealand dollar, and the CHF, Swiss franc. So there's 8 complexes as we call them. So these major things are called complexes as far as we're concerned, and each complex then has an FX pair from the other complexes. So for example, the dollar complex, you've got the euro dollar, dollar yen, pound dollar, dollar CAD, AUD dollar, NZD dollar, and dollar CHF. So you got, this gives you seven FX pairs per complex. So there's $7 pairs, there's 7 euro pairs, and so on. Due to the crossover between each pair has 2 complexes. So the euro dollar's part of the dollar complex and the euro complex. Then you've got 8 complexes, 7 pairs per complex. That's 56. But because of the duplication, you end up with 28 FX pairs. so basically we're dealing with 28 FX pairs. And if you set up your watch lists, so you set up 8 watch lists, and you've got watch list 1, which is the dollar, say, watch list 2 is the euro, etc. Then and you put in these 7 relevant pairs for each complex into the watch list. Then you're giving yourself a good head start. So that's what we're up to there. And we're going to stop it now and go on to the next section. Right, we're back then. So you've set up your 8 watch lists with your 7 FX pairs per complex, as we suggested. And the next thing to know is the cycle of events in the Forex world, the way the markets roll through the different sessions. So you kick off in Tokyo, so it's the Asian session. Then it moves into the early Europe session and London session. And then there's a little bit of crossover into the start of the American New York session, and then you're back in and the day's done, and you roll in back into Tokyo, and the whole thing goes round and round. So we're looking at this sort of wave. There's a wave of trading which goes through these sessions, and sometimes it follows through and sometimes it doesn't. So that's what we're looking at really, and when you're placing orders you need to know what's going on there. So right, the next thing to do is to look at the 2 different situations, or effectively 4, but they're similar, where you can place orders. Now, if you need a trigger, so you need sort of a significant data point, and we've got an example, recent example for you. If I just grab this. Basically, it was the 13th of October 2022, and the data point was US CPI. So you've got some inflation data coming out, and that was the significant trigger for this style of trade. And then you've got 2 situations basically, well, as we said 4, but 2 basically. So if you're placing orders, you've either got so the market has either moved like this, it's had a big move up and then it's consolidated, or it's had a big move down and it's consolidated. This is relatively intraday moves. Or it's had a big move up and it hasn't consolidated, it's near a top. Or it's had a big move down and it hasn't consolidated, it's a floor. Now, in this situation, this consolidation move, this was like we had in the dollar yen. So the dollar yen was the thing of interest. We'll talk about why that a little bit anyway. But anyway, the dollar yen had been pumped, and then they'd had a consolidation phase where basically the market was just dirging up and down in a relatively tight range. Now, and then this data was due to kick off about 1:30 our time, GMT. So if you had this situation, which we did on the dollar yen, you'd need to stick a sell order and a buy order above the market and below the market because of the nature of the beast there. And likewise here, if it had been this situation, we had a decent thump down and then a consolidation, you'd do the same there. However, if you had this, if it had been pumped and it was keeping it at the top, you'd only really want to put a sell order on this one because basically the market is vulnerable to being over pumped, and if the data goes their way, it's going to be a relatively less spike than we're looking for. So, and likewise, if the market's been stretched down to the downside, you're looking for a buy order here, because if the data goes negative and it goes the way people are thinking, then you're going to get a slight spike, but it's not going to be much. But everybody's going to be running for the hills if it goes the other way. So that's what we're looking at. So now in the case of the dollar yen, we could see that the dollar yen was poised for further gains, but due to the consolidation, you'd want to, depending on the data, and the data in the end came out positively. So we had a good thump positive data here, and we got a spike, and potentially our buy order was hit. Our sell order wasn't hit, so you give that the chop as soon as the data's out, because you don't want to be whipsawed, and you're up and running. Now, what were the figures for that then? So the high was 147. What was it? 147. 50. 50/5, and the low was 146. 146.728. Now this is at the 130 mark on a 30-minute chart. Okay, so that is basically, if you're looking at a 30-minute chart, it's gone like that, and it's spiked up after the data. That's the high, that's the low, and you're looking at what are we looking at? 78 pips there, 78 points or pips in that 30-minute spike. Now you're not going to get all of that, it's fair to say, because you're not going to get in exactly at the low, and you've got an order anyway, so you're going to have to have the order above there, and you're not going to get out exactly at the top, unlikely anyway. So you that's about 80 points. So if you say you lose sort of 15 both ends, then that's 30. You got 40 to 50 points up for grabs in a short spike using that approach. Now, with relatively small downside potential, you can put stops in your orders. So that you don't get hammered. You could put a 20-point stop in, and in case the market really swings round and goes whips round, so that's a possibility. But that's what you're looking at really, and that was an example fairly recently, 13th to the 10th, 2022, where you could identify the right FX pair that was going to get the spike, dollar yen. You could identify the trigger data, which was the US CPI, and then due to the nature of the way it moved in the morning session, it had gone up and then it had consolidated. So you needed buy and sell orders, and once data had come out, you chop out the sell order and start monitoring how quickly you're going to get out with regards your successful buy order. Now that's a reasonable way to trade, and it's relatively painless. You don't have to hang around monitoring the screen all day, and it's got potential. And obviously the dollar yen's not particularly volatile pair. If you want to know the relative volatilities, we've got a video out somewhere in the past called "How Volatile Is My FX Pair?" Have a look at that, and you'll find out the relative volatility of the dollar yen compared to the other 28 FX pairs. But to give you a clue, anything with a pound in it is far more volatile anyway. So particularly at the moment as well. So anyway, that's where we are. So just to recap, then you just need to set up your watch lists. Then you need to decide on the trigger data, and then you need to see who's going to benefit or be vulnerable to the trigger data, and then you need to assess whether it's this sort of situation where you get a rise or a fall in consolidation, or are they parking it at the top or the floor, in which case you can get rid of one of the orders depending on how it's formed. So that's where we are. So that's we've been off the game for quite some while on YouTube videos, and we've finally come back. Anyway, I hope that was useful. Put some comments in, assuming they're reasonable, and let us know how you'd like any help or any progression or any thoughts on what we've just said. And we'll go from there, and we'll see if we can carry this on. And obviously, the aim will be to provide a short video on the potential setup that we're going to do before the actual event. So you'll be able to action. So in that case, we'd be saying we're looking at the dollar yen. The trigger data is 130 GMT. What is it? US CPI, and given the nature of the price action, you need to put in a buy and a sell order at those positions roughly. So, and we normally put buy and sell orders about roughly 7 points above and below the current market, because you have to monitor those, because as it gets near, they might tighten up too much. You don't want them being triggered before the data. Anyway, that's just something else. So anyway, I hope that was useful, as we said, and thanks for watching, and goodbye.